What do you need to know about digital currency, including crypto? That's the topic that we're going to address today on Flourishment. I'm your host, Tina Yeager, and today I have a very experienced and distinguished guest with me. His name is Christian Briggs, and he is CEO of Hard Asset Management, and he's got 20 years of experience covering all the topics that you could benefit from in your finances. So welcome, Christian. I am delighted to have you on Flourishment today, and I can't wait to dive into this topic and have the whole audience benefit from your expertise.
Thank you so much for having me. It's a great topic, crypto and digital currencies.
So let's talk about practical tips for the average American household. What do we need to do to not just protect our wealth, but to make sure that we're in a good position when the next thing, whatever it is coming? I'm tempted to say what Pilate said, what is truth? All of these things are perceived value, aren't they?
They are. What I've done, what we do at our company is we help people work with the hard assets. We'll manage accounts. They take possession of their precious metals or their rare coins, but we're active. We look at active accounts and buying and selling and doing well for people for over 30 years now. But when you're looking at your overall investment portfolio, there are great equities out there, great stocks of great companies. The only thing you got to remember is in a severe downturn in the economy, the rotation between one asset class or assets within a specific asset class, I call them the sub assets. You need to make sure that you're not more or less too much in any one of these as the cycles change. So right now we're entering a year of strong dollar, strong inflation, higher interest rates. It's a pro business, pro capitalistic administration. We know this. So you have to look at the dynamics and have to shift. Look at oil is running up. Oil's going up pretty substantially here in the last week or two. Because why? Well, you're going to need more oil if the economy picks up. Well, that's also inflationary. Well, what hedges inflation? Precious metals. What hurts when the inflation runs up? Well, it can hurt equities, right? It can hurt tech stocks because they're very, very sensitive to interest rates. Technology companies usually have a lot of money they borrow. So rates can become, not their best friend, but rather an adversary against a lot of their bottom line earnings. So it's okay to take a profit. I once said it's harder to take a profit than it is to get up on a cold winter morning to get to work. People are like, oh, it's so cold, I want to get up. It's easier to do that than for people to take a profit or to rotate from one asset to the other. And I've always, and again, I'll say it again, and I'll do it over and over. You have to be diversified. Okay, I've said this to my clients, whether they're worth $1 billion or they're worth 100,000, 10 to 20%. But when you go back to some of your original questions, crypto is coming. Okay, it's not the Bitcoin, it's already here. I'm talking about full-blown central bank digital currencies, CBDCs. Look it up. You'll see that the Federal Reserve has already put out a tremendous amount of information regarding this. And so don't be surprised in the next 18 months if all of a sudden your bank says, oh, you're limiting on your cash withdrawals. They do that in Europe now because they're getting ready for their transition November of this year. They'll transition into digital currency called the e-euro. And when they do that, that's going to make cash not worthless, but worth less. That's how it works. It's like a reverse stock split. You want to do a new currency? Well, the old currency will devalue. There will be some measure of devaluation. And if you own assets that are dollar-based, like equities, like bonds, and some real estate, you're gonna see some type of a decline in that value. If you own gold, which is opposite the dollar, when the dollar goes down or a debt goes up or rates go up, hey, precious metals, they shine brighter than a mirror. And that's exactly why they're becoming so strong, is because the rotation has already started. It started about 13, 14 months ago.
So the average family should buy a few bars of gold to keep in the family safe. Is that what you're saying?
Yeah. There's nothing wrong with having gold. Let's this way. If you had put $10,000 in cash 4 years ago in your safe, that has the buying power of about $7,000. Okay. It still has value. 10,000 in gold 4 years ago has the buying power of $22,000 today. It's still cash. You can probably go within 3 to 10 miles, somewhere in that neighborhood, if you're not too far in the boonies. And with this little product right here, you can find a dealer or somebody that will convert that gold into hard cash. You'll never have an issue with finding the value or finding somebody who will take it, even if it's 1% less. I mean, someone makes a little bit of a spread of commission, but at the end of the day, I'm not here to sell you gold. But what I am here to do is to make sure that people understand we have started to transition. It started with Bitcoin in '09 when they launched it globally. It started with Venmo about 7 years ago when they launched it. And now we're programmed and conditioned to use an algorithm to buy and sell goods. So why not transition from paper to full acceptance of digital currency as a country? Because we're already doing it. I mean, the kids, I don't think a person under 25 hasn't heard of Venmo. I mean, they all have. In fact, they use it like regularly. And I've said before, I said, well, I don't think we're going to be able to change that. So in other words, to be able to maintain that wealth or to maintain the consistency of what you've worked so hard for, you gotta be a little nimble. You have to be willing to do a few things. Not hard, it's not expensive, it's not time consuming, but you got to do it. It can take seconds or minutes. And we now have seen that it's starting to go from the billionaires, kind of ripple down, and we've seen people, like I said, with less than 100, 200,000, they have now started buying gold.
Would you recommend investing in some cryptocurrencies like Bitcoin at this point, or should you stay away from that?
Okay, another great question, Tina. So I would say this: crypto depends on what it is. There are software companies that have a token. It's like a share, like stock, and then you can buy a token, which is a share within their company. Fabulous companies out there that do blockchain and distributed ledger. And so when you start to look at those companies, because Bitcoin really is just a one-trick pony. It's an algorithm of value. In other words, the perception created that you can have an algorithm, have value. The reality is people accepted it. But you know what's funny is they're not transacting a lot with Bitcoin. They really aren't. Yeah, there's transactions going on, but it's minuscule compared to the overall local currencies that are used, whether it's the dollar, the rupee, the ruble, the peso, whatever it is. So I would not make Bitcoin a strategic hold of my wealth. Could you have 2% of it in there? Sure, 1 or 2%. Because if it hits, it's going to hit big anyway, like it has. So it'll make a measure of good. And if it does go to south and gets to the point where it's worthless, it's not going to destroy your overall portfolio. But don't go more, because remember, the jury's out on this thing. Right now, it's pure speculation. It's only going up out of speculation. There is no real reason to own it yet. Doesn't mean you can't. Doesn't mean it won't have value. But remember this: if it was so good, why are the top 10, 15, even top 30 governments, top 10 bought a lot, but let's say the top 30 to 40 countries around the world buying gold? If Bitcoin or crypto was the asset to own, why aren't they buying it? They're selling it. They're actually selling their holdings, and they're buying gold. 36% of the gold sold in 24 went to just the top 10 central banks. That's the highest level by leaps and bounds. And people ask, why are they doing it? Because they know that the measure of true wealth is gold. Who gave us gold? God. Who listens to God? We do as believers, and the Holy Spirit tells us. And I'm telling you, as I've said this before, there's an awakening in the last 18 to 24 months, not just in precious metals, but I think in this country, we saw the evilness, or we certainly saw some bad things with this last administration that's leaving, thank goodness. So now all of a sudden, we're in, I wouldn't say a bad economy, but there's a quagmire here a little bit between the debt, the deficit. Trump's got his hands full. And he has said behind closed doors, we're going to have to go back on the gold standard. In order for the dollar to remain the king of currencies, you got to backstop it with something. Because right now, the debt's all people talk about it. You've heard about it. I've heard about it. Interest rates are going up. People are nervous. Stock markets don't like high interest rates. They like low interest rates. And right now, gold's saying, oh, no, those days of low interest rates aren't coming around for at least several years to come. So we may see a whole new monetary policy going digital before Trump leaves office.
I think it's very interesting that spiritually, theologically, and financially, we're seeing a fleeing of culture from things that are true, that are objectively true and sound, into this nebulous idea of no truth, all truth. It's kind of that same way in the financial realm as well. It's almost like the same spiritual strongholds are touching every part of our lives.
It's true. It's true. People have become complacent with their investment money, going, "Oh, I'm in crypto this, or I'm in this investment." And you ask them, "Well, what is it?" "Well, I'm not really sure. What does it do?" "I'm not sure about that either." Well, where's it going to go? Well, I don't know, but this guy told me to buy it. If you were to stick to just very simple godly principles, and they're very simple. Okay. We all know the 10 Commandments are very simple things to follow. But when it comes to your wealth, we are given wealth as long as we're good stewards of that wealth. And tithing, growing the wealth, which allows God to increase his kingdom, which is fabulous. But you got to be good stewards of it first, which means you can't be lazy with it. You can't just say, oh, I've invested. Well, what are you in? I don't know. You'd be surprised how many people with a net worth of over $50 million come to us and say, hey, you worked for so-and-so, you did incredible the last 2-3 years, even in a down market, you're making people money. I'm like, well, yes, because that's the principle of having wealth is good stewardship, whether it's yours, mine, or ours, or whoever's. But people get complacent. We're in a society of complacency where, like you said, all truth can be assembled in a way that, like, okay, it all sounds good. Well, no, it's not all truth, and it's not all good. So don't be complacent to just go along to get along. You need to diversify. And in this world right now, with all of the headwinds that we have, and we've got plenty of headwinds, the banking sector is not as healthy as it should be. You've got banks suing the Federal Reserve the day before Christmas last year in order not to have to meet the liquidity requirements that were now due early in 25 here. They couldn't meet them. They could not meet the liquidity requirements. So they sued the Federal Reserve to delay the requirement of the liquidity requirement. Now, let me tell you something. That's like literally a ship being built and suing the shipbuilder. Don't put that thing to sea yet, but let's go ahead and see if it goes across the Atlantic. But I think there's some holes in it. So I'm going to sue you not to sail the ship, but we're going to sail it anyway. So the banks are still in business, working in a environment where their liquidity requirements and their acknowledgments, they're suing to prevent because they know how bad they are. It's like, okay, you know you're broke, just admit it and let's get a bailout. But they don't want to admit it. The banks are that bad. They're suing because they said these rules are overburdensome. Well, did anybody see 2008? Did anybody check that out lately? Yeah, that's the banks got deregulation, then they got regulated heavy again. Now they don't want to be regulated. So we're in a quagmire here. So the banks don't want to have to admit they're broke. You've got the debt running through the roof. You've got deficit spending that Trump admits. I can't cut anything. Elon goes, I can't cut anything. The whole country is dependent upon government. Friday last week, there was a report out that said we have the highest level of dependency of welfare, food stamps, government housing, and other federal, state, or local entitlement programs. Over 60% of America, close to 62%, do not pay taxes anymore. You can't have it.
This is very interesting. And one of the things that you had said was that we need to diversify in order to maintain, maybe even grow our wealth. And you were looking at the things that God gave us, gold being one of those things. Are there other hard assets that we should diversify in so that we can grow our wealth and maintain our wealth so that we can be the people that are resources for those who are in need in this coming time?
You bet. So we're precious metals, gold, silver, platinum, and so forth. And there's other hard assets like real estate's good. If you buy a farm, make a garden, do cattle, do poultry, do pork, whatever it is you want, you can contribute to your local community for yourself and local community. God gave you two hands, go use them in that sense if that's what you want to do. But when it comes to wealth, we as a society, and I think globally, it's pretty much I can speak for this, have been programmed to buy stocks, and we've been programmed to buy bonds, U.S. government bonds or municipal bonds, which are local government or utilities. And third thing is we've been programmed to buy real estate. These are the three things that everybody says, oh, you've got to own all three. And by and large, they've been great. But remember this, we started in 1979, 80, 81 with a very high interest rate environment. They were high anyway, even before that. But let's talk about that because that's when people kind of remember the Reagan years, Carter to Reagan. We've been in an interest rate decline until 2 years ago for 40 years. We've had rates decline. Of course, you're going to see real estate go up. Of course, you're going to see bonds go up. Of course, you're going to see equities go up. But we artificially built a wealth society. Think about this on two things. One, cheap money, 2 and 3%, 4% money. And two, credit. See, we told everybody, the government convinced everybody, go buy a house, go buy a car, go buy a boat, go buy a plane, start a business, because you can get cheap money. And it did. It But the downside was we got hooked on it, and it artificially increased our asset base too much. If you go right now and you look at mortgages, which are going to be 7.5% here in the next couple of 3 weeks at the rate we're going, could be 8%, in fact, in the next couple of months. If you can't afford $1 million house at a 3.5% 2, 3 years ago, how are you going to get it at 7.5%? Something has to give. If the people trying to buy the house can't afford it, then the house either comes down in price and they lower it, or it doesn't sell. So when you're looking at trying to protect your wealth, you have to ask yourself, wealth insurance, do I have it? Do I need it? And if so, what is it? Wealth insurance is basically having an asset that works not in tandem, but opposite of your equities or your bonds and your real estate. In other words, if those are your three primary investments, diversified, multiple stocks, bonds, and real estate products, like rental property and so forth, what happens if they all go down at the same time? What have you got that's going to grow your wealth, or at least maintain it as a percentage? Gold, silver, rare coins. These things have been bringing about a 15% annualized return when you average by every 5 to 10 years since the 1880s. You can go back if you want to go longer than that. Even during the times of the Roman period, coins were collected and so forth in gold. So diversification is maybe strong a portfolio of equities and stocks. You've got your bonds, you got real estate, but you got to have 20% of your money in gold, because when the times go south, Tina, and things get bad, you're asking for 20% of your money to make up a shortfall of 80% of losses, at least on paper.
I know that you have more information to share, and I wish we had more time because there's just so many more questions that people will have. How can people stay in touch with you, Christian, and get in touch with hard asset management?
Well, go to our website. It's BMCHAM, Bravo Mary Charlie Ham, BMCHam.com. Or they can reach me. It's very simple, initial C at BMCHAM. Feel free to email me anytime you want. Or you can call us. Our toll-free number is right there on the homepage. And know this, that whatever we recommend is based on a very simple philosophy. Whatever goes up must come down. Equities are at the all-time high. Bonds, real estate. So what we try to do is diversify with both midterm and long-term assets, and then we manage those things on a daily basis. I mean, we right now in the last 3 years, we've been averaging about 25% per year. It's like we said before, you're not going to get rich quick with what we do, but you can get richer over time, especially in economic downturns. So if people want to reach us, that's a place to do it, and that's how we do it. It's a very conservative approach, though, to diversification of your investment portfolio, but we're very good at it. And I'm happy to say that in nearly 40 years, we've never had a year of less than a 10% net return. Our years that we struggle is about 9 to 10 in that level, depending upon the net commissions. But we make money when our clients make money. That's how we make it. And their success is our success. So that's how we manage people.
And who is your ideal client? What is the income level or asset base that that person has to have in order for you to work with them?
Start off at portfolios start at $25,000. Usually it's somebody in that 250 to 500,000 investment portfolio range. If it's a little bit less, you can go down, but 25,000 is where our starting point is. And we've had clients come in with as much as $25 million and start right off the bat, but 25 to 50,000 on the low range and 50 to 100, it's kind of that sweet spot. And people, we're on third generation clients now. I've got grandkids who are in their early 20s who are starting to now buy. Their father had success, their grandfathers had success. And like I said, this is not get rich quick, but it will get you rich, because when you do have 2 or 3 or 4 years of downtime, and that means net loss, or at least on paper, your investments actually were declining, you're going to have at least a reprieve with the hard assets. They will go up. That's when they shine. Economic downturns, I mean, gold and silver, they love downturns. They love high interest rates. They love chaotic government policies. They thrive on that. So the good news is when things go bad, you're in great shape.
I hope that all of you listening feel equipped to flourish in your finances this year. And of course, I also hope that you will come back for the next episode of Flourishment.